Hey everybody, Jamie Visconti from FolioBeyond, back from a couple of weeks away from our manager minutes. Just want to focus on something we've kind of been speaking about for the last really month or so, which is risk taken versus current expected returns. We talked about that in the context of where the ag current yield is, which is around 1.25%. We like to look at some, historical data to give that some relevance. If you look at the ETFs we use, there's 23 subsector ETFs we look at, and we can look at the historical returns on those in this graph here, and you can see in basically every sector there's been a positive return, some significant if you look back over the 2-year annualized performance, and obviously with some volatility in that as well, given the volatility we saw this year, but still significant performance, especially among longer duration, higher grade credits, and the markets have benefited investors with that sustained movement over the last 10 years. But it's a very different picture if you start to look at the current expected return on a risk-adjusted basis, which our model does, and you can see in the second graph much lower expected return numbers with annualized standard deviations based on historical performance that obviously implies significant risk relative to the expected return that the assets currently offer. And in a number of cases, for example, like in high-grade treasuries in the intermediate sector, it would take less than a 1% move in the yield on those assets to really wipe out, it would take less than a 10 basis point move in the yield on those assets to wipe out the current projected return of a little over 1%. So in a very different rate environment now, starting at these very low risk-adjusted expected returns, and we think investors need to be conscious of that when they look at historical returns for sectors. That's really not relevant for the analysis. What's relevant now is risk-adjusted expected returns based on current values in the market, and you want to be getting, obviously taking as little risk as possible for the lower expected returns that the market currently offers. So that's it for this week. Hope you are faring well in what continues to obviously have picked up to be a little more volatile environment, and we'll be back to you in the next week with some additional color. Thanks.